We just talked through the summary before I go into a few more questions that were left when people registered for the webinar. We've talked about choosing your investment structure, understanding asset classes, and particular the defensive versus growth, so the property and shares versus fixed interest and cash or bonds. That's the key indication of your risk, and if you at least focus on that one thing in terms of your risk and return, then you will have a good understanding of your investments. Understand your own circumstances. How long have you got to invest? When are you going to be able to access your superannuation money? At what stage in life are you? How much risk can you take? That will give you an indication of when is a good time to change your investment options or what investment option you should be in. In terms of understanding how to prevent loss in your superannuation money, that's really about not pulling out at those low points, not getting into a cycle of buying at the top and selling at the bottom. There was a fund where they did a study of where the actual fund over a 10-year period returned 12%. But when they looked at the underlying investment returns of the individual investors in that fund, the average return of the investor was 2%, because what happened was when the fund had a good year, everybody would jump in. So they'd jump in at this point at a high point. And then the fund would do poorly because it had a whole lot of money that it needed to invest, and it didn't do as well the next year. And everyone would get out at this low point. A lot of people would get out. So they'd sell at a high point, get out at a low point. Then the fund would do it again, go up again, and other investors or the same investors would get back in again. Then it would perform poorly again, and people would get out again. So you want to avoid that cycle of buying at a high point, selling at a low point. That's a key thing. So the idea is that you're getting into the market. Emotionally hard to do, but that's the contrarian type of investing that actually does work well. We've talked about a degree, understanding how the global financial crisis has impacted your savings. And one thing that in last year's session, I raised a little bit about if you haven't got sufficient funds to live on, then consider not retiring if that's a possibility to you. Now, it sounds harsh, and it's people have worked a long time and they're expecting to retire. But if the GFC has so significantly impacted your financial situation that you haven't got enough funds to provide for your living requirements throughout retirement, then one of the best things you can do is to continue to work longer. It's a hard pill to swallow, and caused a bit of feedback in last year's webinar, but it is a message that needs to be, I guess, communicated, particularly as we are living so much longer than we were in the past. If you look at when the age pension was started back in the early 1900s, life expectancy was 63, and the age pension commenced, I think, in the early 60s. So there were very few people that actually needed to utilise the age pension. Now, we've still got an age pension of only age pension age of only 65 or 67 years of age, but we're living another 25 years longer than we were back then. So you need to understand the challenges of providing for that long-term retirement income. And there's more and more about that, and I guess we've all heard it, but if you're in that situation that you haven't got enough to retire, and then don't discount the option of working or working just some part of the time. You can earn $6,500 a year on the age pension, and it doesn't impact your age pension. So it can be a very good strategy to even derive a little bit of income.